How to retire early without regret, even if you don't have a pension. Imagine this. You hand in your notice at 60. The next morning you wake up thinking, this is it, I finally made it. The first year feels amazing. You're traveling, visiting the grandkids, maybe finally buying that cottage. But by year 3, the reality sets in. Markets haven't been as strong as you hoped. Your withdrawals feel like they're eating away at your savings faster than you planned. You start asking yourself questions you thought you never have to ask. Did I stop working too soon? What happens if I live to 90? Will I have to cut back on everything I dreamed retirement would be? I see this all the time. Retirees who worked hard, saved diligently, and were finally comfortable. But without a pension, they find themselves walking a tightrope with no safety net. And here's the truth. When you don't have a defined benefit pension, your RRSP, TFSA, and investments are your pension. And that means every withdrawal decision matters. That's what this video is about. How to retire early, confidently, without regret, even if you don't have a traditional pension to fall back on. Hi, I'm Alex Kellermann, certified financial planner with IG Wealth Management. I work with Canadians who are planning to retire in their 50s or early 60s, and I help them create a retirement income plan that can last 30 years or more without relying on a workplace pension. And if you'd like help building a plan that fits your life, there's a link below to book a time with me. Part 1, why retiring early can be risky without a pension. When you retire early without a pension, the math changes in 2 big ways. First, you're asking your savings to last longer. If you stop working at 60 instead of 65, that's 5 more years of withdrawals, 5 years of living off your investments, and 5 fewer years of contributions and growth. That gap is much bigger than most people think. Second, there's no guaranteed monthly paycheck. A defined benefit pension acts like a safety net. Without one, your retirement income is self-managed. Every decision about withdrawals, taxes, and timing comes out of your pocket. This is why retiring early without a pension is more like walking a tightrope. You have to balance 3 things at once. Cash flow, will your savings cover your spending for 25 to 35 years? Taxes, are you drawing from the right accounts at the right times? And market risk, can your plan survive a bad stretch of returns early on? Even people who have saved diligently can feel stressed once the paycheck stops and those 3 forces start pulling in different directions. Part 2, real numbers, real risks. Let's look at an example. Imagine you and your spouse are both 60. You've saved 1.2 million spread across 800,000 in RSPs, 200,000 in TFSAs, 200,000 in a non-registered investment account. You plan to spend 70,000 a year before tax. On the surface, you might feel comfortable, but here's what's happening in those first 5 years. 1, no government benefits yet. You won't receive OAS until 65, and taking CPP earlier than 65 reduces it significantly. That means 100% of your income must come from your investments. Number 2, where will that 70,000 come from? You'll need to withdraw about 85,000 to 90,000 from your accounts before tax because RSP withdrawals are fully taxable. Number 3, impact on your savings. Even with modest growth, your 1.2 million could drop to around 900 to 950,000 by the time you turn 65. And that's before considering inflation. What if markets drop early? If there's a 20% market drop in your first 2 years, that same nest egg could fall closer to 700,000. This is what we call sequence of returns risk. Early losses combined with withdrawals can snowball. By the time CPP and OAS arrives, your portfolio could be significantly smaller than you expected. This is why I tell clients, retiring early without a plan is like sailing without a map. The water may look calm, but one storm can change everything. Part 3, the strategy that works. So how do you make early retirement work without a pension? Here's a framework I use when building a plan. Step 1, create a year-by-year income map. This is not just a budget. It's a detailed projection showing where each dollar will come from, what taxes you'll pay, and how much your savings will grow or shrink each year. This gives you clarity on how your retirement will unfold, not just for the next 12 months, but for the next 25 to 30 years. Step 2, build a retirement bridge from 60 to 65. These gap years before CPP and OAS are critical. Many Canadians benefit from drawing down RSPs earlier in small amounts while they're in a lower tax bracket. This can reduce large forced withdrawals and OAS clawbacks later. A typical sequence could look like this. You draw 40 to 50,000 per year from RSPs between 60 and 65. You top up the rest from your TFSA for tax-free income, and then you use the non-registered account for flexibility. Step 3, delay CPP and OAS, if the math makes sense. Delaying benefits increases your guaranteed income later. CPP grows by 8.4% for every year you delay after 65 and up to 70, and OAS grows by 7.2%. This is like buying yourself an inflation-protected pension for life. Step 4, protect against market downturns. Have at least 2 to 3 years of spending set aside in safe investments, GICs, high interest savings, or short-term bonds. This allows you to ride out downturns without selling your growth investments at the wrong time. These strategies, when coordinated, turn your savings into a structured retirement income plan that can withstand volatility. Part 4, mistakes to avoid. Here are the most common mistakes I see when Canadians try to retire early without a pension. Mistake 1, retiring based on a lump sum, not a plan. Having 1 million, 1.5 million saved doesn't guarantee success. What matters is how you draw from it and how long it will last. Mistake 2, using the wrong withdrawal order. Many people pull everything from their RRSPs first, thinking they're simplifying things, but this can increase taxes early and reduce TFSA growth. Mistake 3, taking CPP too soon without doing the math. Starting CPP at 60 can seem safe, but it often leads to lower lifetime benefit, especially if you live into your 80s or 90s. Mistake 4, ignoring inflation. If you plan to spend $70,000 a year today, you'll need closer to $100,000 a year in 15 years to maintain the same lifestyle at 2.5% inflation. Mistake 5, no stress testing. A good plan answers the following. What if markets are flat for 5 years? What if one spouse lives till 95? What if tax rates rise? Part 5, what you should do next. If you're in your late 50s or early 60s and thinking about retiring without a workplace pension, this is the window to take action. Here's what that looks like in practical terms. 1, get a detailed retirement income plan. Not a quick online calculator, not a rough, I think I'll be fine. You need a written year-by-year plan that shows exactly, how much you can spend, which accounts to draw from first, what your taxes will look like each year, and what your savings balance could be at age 80 or 90. This turns a vague feeling of uncertainty into a clear path. 2, coordinate your accounts before 71. If most of your savings are in RRSPs, and you need to think about taxes now, not when you're forced to convert to a RIF. Early withdrawals, when done strategically, can reduce your lifetime tax bills and avoid OAS clawbacks down the road. 3, decide on your CPP and OAS strategy early. Don't just pick 60 or 65 by default. Get the math done to see if delaying benefits, sometimes even to age 70, makes sense for your situation. 4, build a cash buffer. Have at least 2 to 3 years of your retirement spending in safe investments. This way, if markets drop in year 2 or 3 of retirement, you're not forced to sell investments at a loss to cover your lifestyle. 5, test the plan against real-world challenges. This is where professional planning adds the most value. We run what-if scenarios for higher inflation, lower returns, medical expenses, living longer than expected. When you can see on paper that your plan still works, even when life throws curveballs, it gives you confidence to retire without second-guessing yourself. The result of this process, well, you move from wondering, do I have enough, to knowing, here's how my retirement will work. The biggest risk of early retirement isn't running out of money, it's running out of confidence. When you don't have a pension, clarity becomes your pension. You need to know with certainty where every dollar is coming from and how to make your savings last. If you're 5 to 10 years from your target retirement age, or if you've already retired and unsure if you're on the right path, let's talk. I help Canadians structure their RSPs, TFSAs, and non-registered investments into a tax-efficient plan so they can retire early with confidence. Click the link in the description to book a free, no obligation consultation with me. We'll build a personalized retirement income plan that shows you exactly how to make your money last without second guessing your decisions. And if this video was helpful, please give it a like and share with someone who's planning to retire early without a pension. For more strategies on retirement planning in Canada, subscribe to the channel so you don't miss future videos.